Good morning, everyone, and welcome to the Lextran Pension Committee Meeting. This meeting was rescheduled from February. Today is April the 3rd. Happy to call the meeting to order and call the roll. Mr. Schoninger.
Here.
Ms. Kelly.
Here.
Ms. Falconberry.
Here.
Mr. Birch.
Here.
Mr. Dial and Mr. Watkins are absent. We do have a quorum, so we can move to the next item on our agenda as approval of the November 12th meeting minutes. Has everyone had an opportunity to review those? If they look good, can I have a motion to approve?
So moved.
A second?
Second.
All in favor, please say aye.
Aye.
Anyone opposed?
Aye.
All right, motion carries. Next on the agenda is the fund performance report from Mariner Wealth Advisors.
All
Take it
right,
away.
thank you. I'll kick it off. I'm Pam Thompson, here with Eric Cole. We picked a good day to reschedule. You probably have all seen the events that have occurred over the past couple weeks, but then especially just yesterday afternoon. So we'll talk a little bit about that. It's all very, very fresh news. The market is down significantly today. So we'll kind of talk through some of that. But as we get started, just a reminder, the first few pages of the book are update on Mariner. We've not had any big new news. We do now operate out of part-time out of an office here in Lexington in addition to Louisville. Eric and I are full-time in Louisville, but spend quite a bit of time here in Lexington as well. I think we've shared with you on the first page there on page 2 that we were recognized by Barron's again in 2024. So we were listed again in the top 5 RIA firms in the country. So that's something that we always get very excited about. We can't pay for that. It's not a size ranking. It's an evaluation that Barron's does every year. So we can kind of sit on the edge of our seats to see how that comes out. So let's kind of fast forward. You've seen all of this before. It's not new information. Our team of advisors is on page 4. But then let's turn to page 5, which is the summary of your investment policy statement. It's important to just always review this and remember that what we are doing for you is in the context of this document. This is your document telling us the basic parameters that you would like us to use to invest the pension plan for you. I'd say the most important part of that is the asset allocation. So that's defining how much of the portfolio should be in stock type investments and how much of them percentage-wise should be in bonds and other stable investments. The range that we have had for many years is for stocks, a range of 50 to 80%, and then the remaining being in bonds and some cash as needed. That is a proportion that provides the fund long-term with nice, moderate growth. It means that when the stocks are doing well, you're definitely participating with that. Stocks are what provide growth long-term. That is very important for a fund that really needs to live on in perpetuity. It does need to grow to be able to meet its obligations. But as we can see over the past few weeks, and especially today, stocks can be volatile. They do go down. It's not just a straight line up. So at times like that, it is so important to have the other part of the portfolio, which is the bonds, the fixed income. So the range there is between 20 and 50%. Bonds are what we call fixed investments. They're like CDs. They're obligations of government or companies to pay you back a set amount on a set date, and they pay you interest along the way. So it's a very secure, very stable investment. So that days like today are helping to hold up a portion of the portfolio, even though the stock portion is declining. Everything else about the policy is to make sure that it is very well diversified. We don't want any one individual stock to be more than 5% of the portfolio, for example, and other aspects to make sure it's well diversified, high quality. And so that's just all very important as we look at the long-term health of the portfolio. Are there any questions, thoughts, concerns? The full document is on the next several pages, so we can move past that and then get into more of the market commentary. I'll kick it off and then let Eric follow up. But on page 17, the chart we have here, because we're just getting to the end of the first quarter, so the first 3 months of the year, We don't yet have the chart out for, okay, how does it look through March, but we had put through March on the right-hand side. So you've already seen the full year of 2024, which is what's reflected in that chart, S&P 500, Dow Jones, et cetera. The first quarter, really just in the month of March, we did see stocks declining a bit, and so you're seeing what those are on the right. Today, at least as the market is just opened, we're seeing, depending on which index you're looking at, another 3 to 5% negative just today. So we are certainly seeing a pullback. A lot of this, the primary driver is the concern over the tariffs. And so we're seeing announcements of things that it's hard to say, okay, what does this really lead to long term? A lot of that depends on how long do the tariffs remain in place. It's a question of, what does it lead to in terms of changed behavior? Do other countries start to change theirs and then we change ours? If that happened quickly, that'd be great and we'd see things come back. But there's a lot of unknown with that right now. And the page that we'll have later in the book, but as you all know, because we talk about it so regularly, is we do expect a pullback or a correction in the market every year. We expect at least 10%. We finally had just gotten that, this March pullback, and so it's remembering how far had we gone up before this. Okay, this is what happens from time to time. It's always a different reason, but as far as market goes, this is not out of the norm, particularly with the strength that we had prior to this decline. One other tidbit that I think is helpful on page 18 that we've included as we see some of this volatility is to look at, okay, if we're looking at just a day in the market, how often does the market go up or down? If you look at that table on the right, if you look at daily returns, this is since 1928, day by day, what's the market doing? 52% of days, individual days, are positive, 48% are negative. So that might be a little surprising because we think of the market going up more than it goes down. But day by day, it can really be either one. It's really 50-50. As you kind of go down those rows, though, you see if we extend to a month, to a quarter, to a 1 year, 5 year, 10 year, 20 year period of time, the longer the time period as we step back and look, we really do see, despite the fact that half of the days are actually negative, longer periods of time, it is predominantly a positive, overall move that we see out of stocks. And so it's so important to, again, be focused on those long-term periods. That's the idea here. We're not trying to call day by day. That's always going to be much more volatile. And then one other piece, and I'll hand it over to Eric, just looking at the bond market environment. So this is not as exciting, but it does define an important portion of your portfolio on page 19. This is just looking at what have bond yields been at different periods of time. So each line is a different point in time. That gray line on the bottom is where rates were at their lowest back in 2020. What we're looking at here is Treasury bond yield. So for example, if you look at that 10-year point, back in 2020, a 10-year Treasury bond was only paying at 0.5%, like less than 1%, which is just so incredibly low. As we had higher inflation in 2022 into 2023, interest rates responded by going up significantly, so that kind of light blue line is the highest point that those hit. Here, the last one we have is as of February. That dark blue line is showing where they were recently. They've actually come down more from that point as well. But from a bond investment perspective, we're sitting at a point now where it's actually nice that we can invest in bonds and earn these kinds of yields. And so these are Treasury bond yields. When we buy corporate bonds, they're a little bit higher than that. That's a nice return finally from bonds, which is a big change after a couple decades of super low interest rates. So bonds are now, from an investment perspective, pulling more of their weight and contributing more to the portfolio, which is nice to have in addition to the stability that they provide. Okay. So that's a high level. I'll let Eric kind of dig in as we get into the portfolio.
Absolutely. And before we leave page 19, I do want to highlight that 10-year rate. At the end of February, it was 4.2%. That is a particularly targeted rate. Our government has, and our Treasury Secretary has identified the 10-year as an important metric. They'd like to see it lower. It's actually closer to an even 4 today. And if you think, where does that impact? That impacts financing, both from a government standpoint as well as a personal standpoint. Your 30-year mortgage is based off of the 10-year, not the 30-year, because most people, even though they take a 30-year mortgage, stay in their house for 7 years. So that's an important rate, and that is moving in the direction, good or bad, that the Treasury Secretary would like to see it moving at least. If we look at page 20 to start to dig in specifically on your portfolio, the breakdown of the overall holdings, I think one of the things that we do want to point to is the overall diversification. 50% of it is in domestic large cap stocks, but you do have an 8% mid cap and a 3% small cap exposure. We do also have that 26% core fixed income plus the cash, and so we certainly have the buffer of diversification. And then right in the middle, international equities, which are performing significantly better this year than U.S. equities, are a little over 8% of the overall portfolio. So year to date, through the end of March, as with all the twists and turns of the market, the overall portfolio was down 2.3%, made up of a positive equity return in the portfolio of 1.9, and I'm sorry?
You said equity.
Oh, I'm sorry, a positive fixed income of 1.9 and a negative equity of 3.8. You can also look back on 24 and 23 and again see that the significantly positive overall portfolio returns carried on the back largely of very strong equity portfolio, equity performance overall, and equity portfolio performance. And then the long-term portfolio return of just under 8% for the last 10 years ended March. So you have strong diversification, you've had strong growth in the portfolio overall, and a good mix between stocks and bonds. We're also currently generating just under $500,000 worth of income from the portfolio on an annualized basis. Page 21 shows the flows in the portfolio, really for the last 2 years and change. So beginning the year at $23,800,000, and then with a market value decrease of just under $700,000 per what we've already discussed. The total portfolio value at the end of March was $23,290,000. That is obviously significant growth from the beginning point of 2 years ago at $17,546,000, and with the requisite cash flows in and out in between. Page 22 is our opportunity to re-examine, and I think it is very important in this environment, how we are organizing the equities in your portfolio. The active portion of your portfolio represents roughly 78% of the total equity portfolio. And from left to right, we have 3 different columns. And again, a little extra emphasis on this today, just because as the market is reorienting, active management is going to, I believe, play a significant part in the returns that we experience. So on the far left, we have our growth and income column. We look at growth and income as your steady foundational pieces that tend to grow, maybe not as dynamically, but in a steady manner. Those are the evidence pieces that we look for. Those types of names are in dividends. How healthy is your balance sheet, and can you reward your shareholders by paying dividends, but not just the highest dividend, because a lot of times that can be a head fake, but are you growing your dividend? So we're looking for a good, strong 5-year dividend growth rate for participants in this column that shows, again, a healthy business with strong cash flows that can pay those cash flows out to their owners. And then the final metric as we list is beta. Beta is a measure of volatility relative to the overall stock market. So if the S&P has a beta of 1 as a benchmark, anything with a higher beta is more volatile than the overall market. Anything with a number less than 1 is less volatile than the overall market. And so what you will see in this in these columns, not universally, but generally and overwhelmingly, is a strong dividend growth rate and a beta or a volatility score that is less than the overall market. And so whether it is Procter & Gamble, which I think was a company born to live in this category and expect to do fairly well in this type of environment, has a 6% 5-year dividend growth rate, a solid 2.5% dividend yield, and a volatility score of 0.4, so significantly lower than the overall market. Right below that is Kroger. Kroger is a recent addition. You may have heard of them. There's a couple of them around here. But again, a very healthy dividend growth rate at 13% per year over a 5-year window, and again, a beta that is a volatility score that's roughly half of the overall market. The last one I'd point out in this group is Costco. There's a lot of calls today. Go to Costco, load up. So we'll see how they do going forward.
Eric, I had a question.
Absolutely.
Out of curiosity.
Yes.
PNC, why would their beta be so high? Is it
You
just
know,
the banking industry?
I'm sorry. I thank you for bringing that up, and I just because I had given some previous examples, I normally point to that. The irony of PNC, their national advertising is, "We are the most boring bank ever, and that's why you love us." And their beta is now statistically, 1.1 relative to 1 is.
Yeah, it's close.
Financials have seen in the last couple of years a little bit of an uptick. Particularly after last year, if we remember, in the spring, you had some fun with regional banks.
Okay.
PNC, although a super regional, is still regional banking. So
okay.
I think we've seen a momentary blip, but yeah.
Okay.
PNC, Pittsburgh National, advertising itself as the most boring bank, and that's why you want to do business with them. And they have the highest beta in the growth and income category, so that's great. The middle group is the cyclical group. And when we say cyclical, what I want you to think of is what companies are actively participating in the economy of the moment. What is happening today that would reward a specific subset of companies? That's the cyclical group. And what you'll see there tends to be a little higher earnings per share growth because, again, they are participating in a segment of the overall economy that is seeing more activity. So you'll see a little higher earnings per share, but the price to earnings, or the measure of their price relative to their earnings, isn't overwhelmingly high. It can be a little higher than the growth and income category, but it isn't what we find in the right side column, as we'll get there shortly. So what has done well, or what is participating? Largely, it is the reindustrialization, reshoring, friendshoring, bringing manufacturing back into the country, or at least to our friends, as well as energy, are two of the major themes. So you see names like a Baker Hughes or Freeport-McMoRan, which is a recent add to your portfolio, with strong earnings per share growth. United Rentals, which there's quite a bit on construction sites around town. You'll see a lot of United Rentals, Rentals, and Corning, which makes a lot of things, including the glass on your iPhones, and Eaton, an international but strong domestic presence that does quite a bit of manufacturing here. So again, a higher earnings per share growth rate, but a more moderate, reasonable PE, because the price and the earnings tend to be moving in concert rather than front-running each other. And then the group on the right is the higher growth group that really have attracted most of the attention over the last number of years, and candidly right now are feeling the brunt of the pain of this year. So here is where you will see a higher earnings per share growth rate. They are growing their business and they're taking whatever money they have and plowing it back into their business and continuing a growth cycle. Very few dividends being paid out of this group, and not none, but very few. And you'll see higher earnings per share. You'll also see, because of the rapid earnings growth, you'll also see higher valuation. So you'll see a higher price to earnings ratio in this group. Although again, right now we're seeing some recalibration of those numbers. So this is where you will find an NVIDIA or Palo Alto Networks. Let me focus on them for a little bit. For everything that's going on now, one of the things that will not be in less demand is cybersecurity. So whether it is Palo Alto, which is the class of the group, or CrowdStrike, or any number of those names in that area, they have very durable businesses with a moat. So I would expect those to continue to do well. Apple's in here, Oracle, but again, the names that are in here, they are growing their earnings fast, and shareholders have been paying up for that, so you've seen a higher PE. These have been the names that have largely been driving, coming into this year, the performance of the equity market. And it is not a secret. Now, where do we fall at this point? And in communicating with our chief investment strategist yesterday around the tariff announcement time, he said it's a good thing we've been doing some recalibrating. And this is where our active management really does come into play. That there isn't a set number in the left column, the center column, and the right column. Those columns will shift and flow. You'll never be absent any of them, but you'll see shift and flow depending on where are the markets today? Where do we expect them to be? What is the economy doing? What is happening? And our active management allows us then to make decisions. The tariff announcement may have been larger than we had hoped, but it didn't come as a surprise to anybody who's managing money at Merit. Maybe the scale, but not the fact. And so adjustments in advance of this are the types of things that we look for active management to provide and help with the diversification of the overall portfolio. And so the likelihood is when we're back here in a month, basically, that we may have a few more names on the left, or at least there's some weight taken out of the names on the right. That I can tell you with certainty that moves and active decisions are being made on behalf of your portfolio. The top 10 individual equity positions in the portfolio as of the end of March are listed here. You know, some of the names, and I'll remind you the 5% cap is on total portfolio, and these are percentages relative to simply to the equity position. that the companies on this list, even if they are having a more difficult time today, literally today, are still very good companies with very strong earnings. And the percentages will likely come down. Market forces themselves will do a lot of that work for us. But the overall belief in a company like Microsoft that continues to perform and drive earnings hasn't necessarily disappeared. It's just what is the market rewarding. But even since our last meeting, a name like AutoZone or Marsh & McLennan that have come into the portfolio and have risen as we make changes and see opportunities, the portfolio has changed and continues to change. On page 24 is the sector breakdown, again, as of the end of March. I pointed this out a number of times. Some of these numbers are interesting to look at, but they do better when we have context. So, for example, the top sector of technology is 28%, so over a quarter of the overall portfolio, and that on its surface may seem high or distorted. That's actually underweight the S&P index, which at the end of March was sitting at just under 30% of its portfolio. So there aren't really any significant departures, by which I would define plus or minus 3% of the S&P's weighting in any of these groups. And for example, utilities at just at 1, its overall exposure is 2.5. In a portfolio, that's 1 holding plus or minus, so it's not a significant departure. 22% of the equity position is in passive strategies. Passive strategies are those that are simply following the rules. There's not any active management or fundamental analysis that goes into them, and they are replicating the indices that are listed. And so the holdings and the performance are listed here. There is the growth index to give additional growth weighting, the value index for the counter. There's also the Russell 2000 index to increase the representation in small and mid cap, and then your international weighting in the EFI, which is the developed market international position. The thing to point out here, again, the benefit of diversification, not just between active and passive, which is in itself diversification, but between domestic and international, where the S&P 500 is down as of the end of March at roughly 4.3%. The developed market international at the same time is up 8.1% in that same period of time. So where the international diversification benefits the overall portfolio, which is particularly striking because I can't tell you how many meetings I've gone into the last couple of years where people say, why do we own international? Shouldn't we just be an all domestic? The international is holding us back. Well, this is why we do it. On page 26 is the overall bond review. What I would point out here is that the weight in the high quality bond portfolio is in the 5-year and under weights. The reason being is that's where the value of the bond market is. If we were to flip back, and I won't make you do it, but if you were to flip back to the interest rate page, you'll see that it is, while it is a normally positioned curve and that the rates on the short end are lower than the rates on the long end, it's awfully flat. And once you get past 10, the 10-year mark, the rates are basically the same all the way out. There's no additional value in buying a 20-year bond. You're not getting any more yield than what you get on buying a 10-year, and you're not getting significantly more in a 10-year than you are in a 7-year. So most of the weight of the bond portfolio is in that 5 and under, because that's where you're getting paid. Excuse me. Any questions here before we move into the fireworks portion of the economic market overview? Excuse me. You know, I did find it telling that the last meeting was rescheduled for a snowstorm, that this is better weather than when we had our last guy.
Yeah.
The tornado sirens last night, and that was better. All right, on page 28, this is a new chart that we've started for providing for context, and it's a graphical representation of economic cycles dating back into the 1800s. And really what you are seeing is some trends, some of which are explainable, whether they matter necessarily in this context or not, in that the cycles themselves, the expansions are getting longer on average, and the contractions are getting shorter. But you know, that is really obvious, and we've experienced that there's some rationale behind that. One is we have matured as a country and evolved as a country, that more of our spending is done by internal consumption rather than trade. That gives us a smoother cycle. It's also true that the additional government spending goes directly into GDP, and as that goes up, that provides a GDP catalyst and smooths some cycles, for better or worse. It's just, it is what it is, so that's part of it. However, when we are now in such a displacement of expansion to contraction, it is not abnormal or unreasonable to start to say there will likely be and a healthy reorientation and a contraction is necessary in order to bring us economically into balance. It doesn't mean it has to be harsh. It doesn't mean it has to be necessarily super long, but we've gone a while without a significant contraction, and the last one we had lasted 2 months. So the displacement between the expansion and contraction cycles right now is a little off. Again, some of which for very explainable reasons, but it does send us signals to be particularly on the lookout as we move forward. The next chart is the stock market times of war. Now, there's different ways to look at this. As I look at it, this is the stock market during World War II. And you would think that in a very, obviously, to put it mildly, difficult global environment, that the market would not do well, and that there would be a lot of long-term and prolonged pain financially. And from an investment standpoint, that simply wasn't the case. That we see this more often than not, that significant events have very acute moments where you have market turbulence and market pain, but over the long term and even the intermediate term, the equity markets tend to do well, and that there are beneficiaries. Again, coming back to the benefit of active management, there are beneficiaries. Even today, if you look at the tariff issue, if you're a company who does everything inside of the country, probably pretty happy today, and you're actually up. That isn't most, but there are opportunities. There are opportunities to be found. On page 30, we've talked about this every time I've been in here. Is inflation. The long-term trend for inflation is still down and beneficial for us. And I am fond of reminding people that we talk about inflation as one big thing, but everybody has a different inflation rate. For all the hue and cry about eggs, I didn't notice. I mean, I get 20 of them a day, so my chickens help me out. So my inflation rate's a little bit different from somebody who goes to Kroger every day and buys eggs. Not to brag. But there are some things here that continue to be very sticky from an inflationary standpoint, one of which is shelter. That won't be solved until there's an inventory solve, and that's likely to be a long-term, persistent, although very difficult to calculate metric. The other one is auto insurance. Auto insurance continues to be high and continues to be inflationary and add to that number. That is a pain point for many of us. Say in this room probably has some impact, and that is just something that we're dealing with. And then the other one is if you dine out, you are feeling the inflation rate more than somebody who tends to eat at home, because dining out continues to be significantly inflationary. Now the good news is that some of our day-to-day expenses like energy, staples, going and buying toilet paper, things like that, are flat. They have been actually in the deflationary cycle for a few months, where they actually were getting cheaper, not just growing less quickly. Those have now flattened out, but still there is overall the inflationary trend, I would say at this point, is stable and is certainly down from its peak, which has led to some interesting signals from the Federal Reserve. The belief in the Fed, at least going into today, was there would be. They were telling you that there would be 3 rate cuts. The market has not believed them. The market continues to not believe that there will be 3 rate cuts. We're looking at a long-term federal funds rate average from its current 4 to 4.25 level to 3.54. The Fed is telling you long run it'll get down to 3. We'll see. I mean, the trend is a push down, not a push up, and I don't think that has changed. It is just the rapidity at which rates will come down, with obviously balancing the concerns of inflation, which is not yet to the 2% target, and economic contraction and unemployment. So they have a not easy job to do, but again, the interest rate trend is certainly pointing down. Page 32 is a change, is a chart that we've changed here recently or updated to reflect the current environment. And it's a way that we evaluate individual stocks through a fundamental valuation and technicals lens. The takeaway from this chart is in the pluses, minuses, and zeros, where the zeros are a neutral weighting, a plus is a positive indication, and the minus is a negative indication. The change that we look at is really, if you look in the technicals, that's where, to me, the noticeable change has come. On the negative side, the only neutral negative reading currently is the advanced decline line. That is measuring all of the stocks that are out there, what number of them are going up versus what number of them are going down. A momentum in buying is a positive for the market. The trends can tend to have their own inertia, and so if you can track that, then you can get a pretty good sense of where the overall market not just is, but is going, at least for a little while. That has turned slightly negative. It isn't an alarm bells get out, but it does mean that's something that we watch in terms of balance. On the other side of that is sentiment. Now, I've talked about sentiment in the past because in previous charts, that has been our only, previously our only neutral negative reading. Everything else was either neutral positive, or positive. That has now turned to neutral positive. Why? Because sentiment is a contraindicator. Sentiment is a technical vision. Basically, think of it as everybody who has money to invest is already invested. There's not more money to invest, and it's probably a market high, and it makes you a little cautious. Well, right now, it's just the opposite. It's all doom and gloom, and sentiment has gone down. And that doesn't mean that we are all chips in the middle of the table and buy everything that you can, but it does mean that if you were to ask us 6 months ago relative to today, if you had a new dollar to put to work based on sentiment, we'd be more comfortable doing that today than we would have been 6 months ago, because there was so much existing money already in the market that it leads to a concern of being a market top. So there are both positive and negative signals, even as we sit here today, looking for opportunities to put money to work. There always are, and we're constantly reevaluating that. So these are updates. And then finally, Pam referenced this, finally in terms of charts at least, Pam referenced this, and we make sure to point this out in every chart, that every year we expect there to be a correction. I mean, there is a correction every year, but there is a correction in 34 of the last 45 years, a correction being defined as a 10% pullback from the previous high, not the calendar, but the previous high. And the average is 14%. Now, haven't had a chance while we're sitting here to do the math today, so I'm not exactly sure where we are today. But we did reach that 10% level on March 13th of this year from the previous high. Now, when we were down 10% from the previous high, that previous high was February 19th. So that was a very abrupt drop. And at that point, the overall market was down 6.2 for the year. So that's where that falls. The counter, or the other point of that is, while we have a correction on average of 14% in 34 out of 45 years, in the vast majority of years, roughly 75% of all calendar years, the market's positive. So it is very natural to have these pullbacks inside of what ultimately are positive years. We expect it. We're actually surprised, like last year when we didn't get one. We tried really hard. We got down to 8. the regional banking crisis was, did its best to get us there, not quite. But we've gotten there this year, and it would not surprise us if we, particularly now, if we revisit that. But just to give some context in terms of, excuse me, in terms of overall numbers. Let's say instead of a correction, we have an actual bear market, where we're down 20% for the year. From the beginning, or from the all-time high, which was 61.44 on the market on the S&P 500 on February 19th, that would represent about a 1,200 point pullback and would get the market down to 49.15. Anybody want to take a guess when the last time we saw 49.15 on the S&P 500? We can take it from this.
COVID.
It would have been February of last year. So it is not fun for most. It is not, but it is also not abnormal. And we've had so many gains in the last couple of years that even a 20% correction, we're still on a very good growth path long term. So to go back to the chart that Pam shared, if you look really close, everything looks very rocky almost every day of the trading year. The farther you pull back, the smoother the chart gets, and the more up and to the right it goes. And that is, I was saying that it's always the train you don't see coming that hits you. Maybe in this room it's better to say the bus. But the reality is there's always a surprise. There's always something coming. But as we pull back and we look, it presents opportunities, and the market continues to move through, and we are long-term investors, and this too shall pass. And the last thing I will say is diversification has been our friend, because you are in international, you are in bonds, and this is why we diversify and just don't buy the equity markets when the equity markets are rolling and it seems like trees might in fact grow to the sky. With that, we're happy to take any questions. I do have some additional books here for people who are not here that we can leave for distribution as well.
Any questions? Okay, thank you, Pam. Thank you, Eric.
All right.
Next item on our agenda is old business. Does anyone on the committee have old business? Any new business?
Motions.
Motions?
The first motion was, I would like to move to have the pension plan included in the policies available to all workers in PAYCOM.
We can do that without a motion.
Huh?
We can do that without, we can just do that,
Oh, okay.
right? I mean, we can put that in NACOM, no problem. Yeah, we'll get that done.
That plan right there?
Yeah.
Yep, we can do that.
The next one is under Article 3 of the pension plan, conditions of eligibility, somewhat of a housekeeping change. It references an employee who is a member of the union. It should say a member of the collective bargaining unit, because the bargaining unit is larger than the union, and we don't want anybody saying, well, I'm not in the union, so you can't take my money. And I don't know if that's referenced to other, I didn't do a search of the document, so I don't know if that term is referenced elsewhere.
There are references to all employees.
In the document? Okay. Steve, do you have any thoughts on this one?
That seems like that would be an easy fix if
Okay.
that's what y'all want to do. I mean, does it pick up, so like you said, it should be the people in the collective, covered by the collective bargaining agreement as opposed to in the union?
Although it's only full-time, right? So that isn't added in here. Because I don't know where it's defined that part-time members do not, part-time workers do not participate in the pension. It's not in the contract,
But one thing we can do is review,
the language.
yeah, we'll get the
Come back in
attorneys to
May.
review the language and come back in a month with a formal resolution for the committee to consider.
I also have one that Steve and I had talked about, the collective bargaining agreement we changed, back when we signed the new agreement to be at probation is 720 hours instead of 90 days. To change that to be when, they're eligible to match the CBA.
We reject that because it introduces unfairness, which we fought against years ago. Some employees come out and they are extra drivers. They'll be working 12 hours a day, 5 days a week. They will complete probation much faster. They would end up paying more into the pension for no additional benefit. So we reject that principle entirely. Secondly, the pension contributions are not currently in line with the pension plan or with our probation. So it's puzzling why this change is being proposed when we're not even doing it that way now. My pension contribution started 90 calendar days from hire, which is very different from what's in the pension plan and very different from our contractual probationary period. Our contractual probationary period is, under the last CBA, was roughly 4.5 months. It was 90 regularly scheduled work days, so if you worked a 5-day week, it took about 4.5 months. If you had a 4-day week, it would take longer. My pension contributions, my first day counting towards my probation was August 14th. My pension contributions started mid-September. It was around the 18th, 17th, 18th, 19th of September, whatever the payday was. My probation did not end till at least the end of January. So I was paying into the pension long before I was off probation. This has come up with people having money taken out of their checks and coming to me saying I'm still on probation because there's literature floating around from Lextran saying that it's tied to your probation, but it's not. It's not tied to our contractual probation. It's not corresponding to the pension plan. I don't see that it has anything to do with job performance. What I think is fair is that everyone gets the same benefit, so everyone should start paying at the same time. So if that's 90 calendar days from hire, then that's what should be in the plan, and that should be communicated to everyone. If you wanted to make it 90 work days, that's different from 90 calendar days. You'd have to change how you're doing it, but you'd have to do it the same way for everyone, otherwise it's not fair. And we were disadvantaged severely in the past by having to contribute on overtime. So you had people working all this overtime, having pension deductions taken out every hour for no additional benefit for, I don't know how long, decades apparently. So we ended that around 2018, I think, 2017, 2018. And we want it to be fair to everyone. So if we all get the same benefit, then administrative employees and bargaining unit employees and management should all be contributing starting at the same time. I don't have any strong feelings about when that is, but it should be the same for everyone. That's what I insist on. So we should probably look at all that and come back in May. That would be easier.
Yeah, let's, so we have,
Well, the plan,
go ahead, Steve.
the plan document says you enter if you're staff after 90 work days, and if you're in the union after a probationary period of 90 work days.
But the deductions are starting after, at least for mine, and I haven't done a survey to make sure everybody was done the same. But my pension contribution started about a month into my probationary period, which lasted about 4.5 to 5 months. So the language the language in the contract has steadily changed over many contract cycles. So it used to be like 60 calendar days from hire maybe, or then it changed to days from our seniority day. The seniority day is the day we come out of training, and that's when our probation starts. So I don't see why it would need to be tied to job performance. The probationary is to assess your job performance. I can see how you would not want contributions to start immediately upon hire because you're going to get attrition, and then you got to do refunds. So you'd want to have some kind of introductory period where you're not paying in the pension just to soften the impact of all those, all the work for Nikki to do. So I don't feel strongly about when it starts. I just feel very strongly that all employees should pay the same amount in if they're getting the same amount out. And that's kind of how it's been done, assuming that you're doing it 90 calendar days for the admin employees, to do it 90 calendar days for the bargaining employees. That's actually what's fair. That's why we haven't made a big stink about this, because it's fair to have us both doing the same. It just doesn't match the language in the pension plan. So I was wanting to make the pension plan reflect what the actual practice is and make sure it remains the same, that everybody's treated the same way going forward, regardless of what our probationary period ends up being. You get it, Todd? Is it clear?
No, I'm with you. I understand.
I got it.
Okay, so I think what we should do is have this reviewed and come back next month with
Exactly.
exact language. Does that seem fair to the committee?
Do you need that in the form of a motion?
I'll let Fred say.
Okay.
I'll do it whether you.
Okay, oh, I'm happy to second that, that makes perfect sense.
Okay. Any other new business? Okay. Anyone else have new business?
I have a question for Steve.
Sure.
Steve, the number we're interested in is the surplus. Can you report to us over the course of the next year about how the changes in the market, the change in the benefit, and the changes coming with the new tariff stuff, how that affects our surplus over the next year? And could you report today what the surplus is?
Well, we're working right now in my office on updating the surplus at the beginning of 25. So I don't have a number that's any different than 18 months ago or 16 months ago.
Okay. That's
No,
not,
we'll have that.
we want to see how what happens over the course of the year, how that affects that number.
Yeah,
Okay?
I'll have that for the main meeting.
Okay. Thank you.
Any other thoughts, comments, questions? All right. Next meeting is May the 13th. Is that right? May the 13th. And we stand adjourned. Thanks, everyone.
Thank you.